The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Big tech rallies for a fourth straight week while Treasury's selling off for a fifth straight day. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Alex Steele. You just labeled it. Two big stories.
Yes, I did.
Yields and tech.
All right, you have a third?
I don't. I really don't have a third. He's going to make up a third. But and this is really what we're seeing in the boards as well. Well, that's Jay Powell. But in theory, we're wind up looking at S&P is pretty much flat on the day. Tech outperforming. I do air quotes because it's not really moving that much. It's because of Broadcom up a whopping 25% after earnings. On the flip side, you have the bond market a sell-off, and you got yields higher. You get higher yields, and tech still holding it.
Feeling some Friday vibes here. That's a beautiful picture of Jay Powell, by the way. Nice close-up shot of the man in charge. And maybe it's appropriate that we did have him up there because there's a big question mark right now around this stock rally and a big question mark around Jay Powell and the Fed. Will a widely expected quarter-point interest rate cut next week give stocks another leg higher? Well, the bond market seems to be saying no. A 5-day sell-off across the Treasury curve, pushing 30-year yields up the most on a weekly basis all year long. And the spread between 3-month bills and 10-year notes, which reflects how investors see Fed policy affecting economic activity, that disinverted this week for the first time since 2022. Now, that's not necessarily bad for the economic outlook, but that's not necessarily supportive of the rate cut outlook either. Next week's Fed meeting will include an updated summary of where officials see the economy and interest rates over the next 3 years, as well as their estimates of that elusive neutral rate. Rick Reeder of BlackRock's fixed income CIO telling Bloomberg the bond and swaps positioning suggesting the Fed in 2025 may not move as aggressively as previously thought. And maybe that's why you're seeing the S&P stalling out just a little bit after 3 weeks of gains with almost 400 individual names in the red over this 5-day stretch. An analysis by Bespoke shows that since November 29th, there hasn't been a single trading session where more stocks in the S&P gained than declined. That's the longest streak of negative lopsidedness that we've seen in more than 20 years, Alex.
Right, and that really raises the question, if you can't broaden out now in the Santa Claus rally, what happens in January? That's what BTIG was saying yesterday. Here's a visualization of what Romaine was talking about of the spread between 3-month yields and 10-month yields. Now, I reversed it. So this is 10-year yields minus 3-month yields. So you can kind of see where it winds up flipping negative. So this is the first time since 2022 where we've seen the 3-month yield fall below the 10-year yield. So we're about -7 at this point. Now, back in 2022, that's when the Fed was actually increasing rates. You saw like a 200 basis point move for 3-month yields and then much less when it came to the 10-year. Now what you're seeing is 3-month yields come down as we're expecting a cut next week, but back-end yields continuing to rise. You can make an argument, Romaine, sure, maybe there's positioning, but also is that a growth question mark? Is that we're not going to be able to cut as much as we thought, or a higher neutral rate question mark? And that's why we're seeing that rise in the back end. And then what does that mean for equities?
All right, well, let's pose that question to our first guest as we kick you off to the close here on this Friday afternoon. Rebecca Patterson has a wealth of knowledge, a lifetime on Wall Street, formerly the chief investment strategist at Bridgewater Associates. Rebecca, great to see you here. And I know there's a big parlor game, not so much about what necessarily happens next week with the Fed, but really kind of what happens in 2025. I have no idea where the neutral rate is. I don't think the Fed even knows where it is either. No. But we've got to move somewhere. And I guess the big question is exactly where are we going to move?
Yeah, and the market now is pricing in about 3 rate cuts next year. So 1 next week, 3 more next year. I think we have to wait and see what policies we get with the new administration. Do they lean in hard on the fiscal stimulus, and does deregulation happen faster than hoped? That could keep the animal spirits alive, help the bank stocks, help M&A. That certainly would be a big positive. Or do we get some of that, which is increasingly priced in, but we also get increased tariffs, massive deportation that hurts the labor market? Then we could be looking at a repeat of 2018, where stocks rose for the first 3 quarters of the year, but then fell 20% in the last quarter for 2 reasons: the Fed and a growth scare because of trade.
That's, and this is something, and I've heard a similar sentiment from some of our other guests over the past few weeks since the election. Some are okay with that. There are other folks that are basically saying, look, we need to reposition around the economic impact of some of these policies, even though it's still kind of early. We don't know exactly what he's actually going to do and how it's going to impact it. But when you start to think about what we've learned in his first 4 years, how much of that do you think is going to be applicable to what he may do over the next 4 years?
I think there's a lot of good lessons,
Yeah.
right? We know campaign rhetoric doesn't always become reality. And we know this time that the fiscal stimulus is going to be relatively smaller, right? We're extending personal taxes. We're not cutting personal taxes. So the big stimulus, the change is on the corporate side. So it's relatively smaller in terms of an impetus than last time. Deregulation, it's going to happen. The question is how much and how quickly. Normally these processes take years. So they'll get through, it'll have an impact, but how much do we feel it? How quickly do they feel it? Trade, we have to see. What is rhetoric? What is negotiation? What happens? The one thing I'd mention though, one of the tools that wasn't used a lot in the first term that I think we want to keep our eyes on, I'm going to get wonky here, Section 122.
Okay, all right.
So get that in your head, 122.
All right.
So if a country has a bilateral trade imbalance with the U.S., i.e. it has a weak currency, it has a trade surplus, we can throw on a 15% tariff for 150 days while we're figuring it out. So think about the countries. Japan.
Yeah, I was going to say Japan.
China. I mean, there's a number of countries that the new administration could easily go after, in addition to all the other tools they have at their disposal.
Okay, so the rudimentary question is, like, what happens to the 10-year?
Right.
And I joke because those are, like, serious things that could happen to the economy. But the 10-year BNP Paribas said you could see, like, 4.65% next year. That would be very different than a scenario we expected just even a few months ago.
Yeah, I think that number is very plausible. I mean, you think about the fiscal stimulus, we're not going to have enough offsets, so the deficit's going higher, more supply. Are we going to get enough demand to meet that supply? Well, if a lot of that demand is coming from overseas and we're putting tariffs on those countries, how much does Japan and China want to buy our bonds when we're throwing tariffs on them? It's a question mark.
I don't know, 4.5%. Maybe they will.
Maybe. Again, it's a question. It's not a view. But I think the bias of risk for yields, both because we're going to have strong growth, at least at the get-go, right? We're running at 3.3% now. So strong growth, inflation upside risks, I think, next year, and then demand supply question marks, I think, put a bias higher under yields on the long end.
Okay,
question is how high can they get before it tips stocks over?
Well, that was my question. And I look at something like small caps, right? They haven't been able to catch a sustained bid.
Right.
But in a world where you see deregulation and lower taxes, they should be catching a sustained bid.
They should, except they are much more reliant on floating rate debt. They have a lot more debt than the large caps. And so if yields are ticking higher, that is going to be a headwind for them. So they'll need a lot of those earlier positives you mentioned to offset the higher yield.
I am curious, though, too, when we talk about the shifts in yields, and we talked about the disinversion on the 3-month, 10-year, and the idea that actually that might, at least for some folks, that might actually open up some opportunities with regards to the carry trade. I do want to talk a little bit more about the carry trade in the broadest sense of that term, not only what we're seeing in the rates market, but obviously as well with currencies. There's been a lot of repositioning already by foreign investors as well as investors here in the U.S. I'm not sure to what end, but just, I don't know, about 2 hours ago, you saw Brazil actually did a relatively rare intervention based on where the currency did on the real and as well as what their benchmark 10-year deal did. I'm not sure it worked immediately, but I assume this is going to be one of many interventions that we see over the next few months and years.
I think this year has been really active for currency markets. I think next year even more so. And it's really important, even if you think, well, I don't invest in currencies. If you're a global equity investor, this matters. You know, this year, if you bought the Nikkei, let's say, you believed in Japan, you wanted some overseas exposure, if you took out the currency, so you sold the yen but kept your stocks, you made about 18%. If you didn't take out the currency, if you held the Japanese yen, once you brought your profit back home to America, you made 8%. So 10 percentage point difference in return. It's material. Brazil, much bigger spread this year. Europe, big spread this year. So understanding how those currencies are going to affect your return in other asset classes next year will matter. And you could think, well, currency's cheap in Europe. European exporters are going to do great. Well, they should, but not if they're getting tariffed, which they very well may be. So there's a lot of second and third order effects next year when we think about these government policies and the markets and how they're feeding through. That's going to make it an academically rigorous year for investors.
Academically rigorous year. I hope they're ready for that, Rebecca, because not everybody wants to get as wonky as you do, but they may have no choice. Rebecca, always a great conversation, and we're definitely going to catch up with you at the start of the year. Rebecca Patterson, former chief investment strategist at Bridgewater Associates. Some breaking news while we were in the middle of that conversation involving Lamb Weston and Post Holdings. Reuters reporting that Post Holdings is working with investment bankers to explore a way to own Lamb Weston. Right now, Post has a market value of about $7 billion. Lamb Weston not commenting after being approached by Bloomberg. We'll try to get you some more details on that, but you see the spike in the shares on Lamb Weston up about 4% as we barrel towards the closing bell here on this Friday afternoon. A conversation coming up here about New York's luxury real estate market. It is finally waking up from a long hibernation. A conversation up ahead with one of the star brokers right here in New York City.
Did you make a bid yet?
Not yet.
You got your luxury apartment?
Yeah.
All right, now from luxury real estate to luxury furniture, you got RH sales are up a whopping 15% after it raises revenue forecast, while several analysts see accelerating demand for the brand and what it means for the stock price trajectory.
And with the Fed's final decision of 2024 coming down next week, we're going to look ahead to 2025 and the possible rate path going forward. Julia Coronado going to be joining us from Macropolicy Perspectives. You don't want to miss that and so much more coming up right here. The Close on Bloomberg.
One day you're in and the next you are out. After today's closing bell, the Nasdaq 100 is expected to announce a shuffle. Palantir, MicroStrategy, and Axon could replace Moderna, Illumina, and Supermicro Computer on that index, which could result in lots of flows on ETFs that track that index. Joining us now to discuss is James Seyffart of Bloomberg Intelligence. He covers the ETF landscape. All right, James, walk me through how you got to these names. Why do we think that those will be out and those will be in?
Yeah, I mean, you just basically it's reading this really long index methodology document that NASDAQ puts out on how they're going to make the changes to their index. Basically, the only way to get in as a new entrant is to be in the top 75 of all companies listed on NASDAQ that are not financial or REITs or SPACs. And those three names fall squarely into the top 75 by market cap. So they're likely to be in. Figuring out who's going to get kicked out is a little more complicated. So those names getting kicked out is not, I'm not as confident as I am on the names that I think that will likely be put in. But yeah, look, Moderna almost certainly is going to be kicked out at the announcement after it closed today.
So perspective is we're going to get the announcement like way late. We don't really know when, but it'll happen. And then what happens on the index level and then on the ETF level?
Yeah, so the announcement is expected at 8 p.m. today. And then the rebalance actually is going to occur on Monday, the 23rd. So technically after market close next Friday. So basically they give everyone a week to get ready. And those passive indices that track the NASDAQ 100, which I have about 451 billion that directly track the NASDAQ 100, mainly the Qs and QQQM here in the US is where we're looking mostly. But there's also a ton of other ETFs, equal weighted or ESG version or some other subset of the index that adds another 100 billion here. So there's a lot of passive products out there that are going to basically follow what this index move does.
I am curious, James. I mean, I think it's relatively easy to kind of see which names are going to end up getting bid up as a result of this. I am curious about those names that could potentially get sold off, not necessarily the ones coming out, but those are the ones that may have their weightings changed to a point where you do see the passive investments and even some of the active investors have to actually reduce their allocations.
Yeah, I mean, this is a big game, right? There's a lot of market makers and traders out there that were doing this weeks before I even wrote my note, trying to predict what's going to happen. So I talk to a lot of people that are doing that whenever I put these notes out. But really, the main one that's going to see the most selling is likely going to be Meta. And that's only because there's a cap, right? So one of the things here is you can't have too much concentration at the top of any index. The S&P 500 has this issue. There's a lot of other ETFs that have these issues. And basically, Meta falls out of the top 5 there. And it's going to be capped at 4.4%, despite being about a little bit over 5% currently. So that's going to see a significant amount of selling. I think $3+ billion is going to be sold from Meta, most likely. So that's the number one sale. Then obviously you have the names that we talked about, Moderna, Supermicro, Illumina, that I think are going to be sold. But there's also a couple other names in there that could get the boot as well. But those are the most likely 3 in my view.
And just a quick final question here as to the names being added. There's a lot of people looking at MicroStrategy and saying, should it be there? Kind of a similar way that I think a lot of people looked at Supermicro when it was added to the S&P. In a year's time, do you think we'll be looking at some of these names on the list that are going in and saying maybe they shouldn't have gone in?
I mean, it's possible. I mean, Supermicro only went in last year, and it looks like it's going to be kicked out this year. Obviously, they've had a bunch of accounting issues. But for MicroStrategy specifically, that's the most, complex one. There's a lot of strong viewpoints on either side of that. But really, passive investing, you have a set of rules and you follow them. And as far as I can tell, the rules say it should be added. The one caveat here is there's a lot of people saying it shouldn't be classified as a tech stock, despite its business. It's a software as a service stock, is tech. But a lot of its value comes from its Bitcoin. So that's one way it could possibly not get in. But right now, it's still classified as a tech stock. And following the rules, I believe it should be added.
James Seyffart over at Bloomberg Intelligence. If you have a Bloomberg terminal, he has a nice breakdown of what he thinks is going to go into that index and what is going to come out. An official announcement from the NASDAQ expected after the bell later in the evening. Meanwhile, there was another interesting story in the Bloomberg terminal about Will Danoff. I don't know if you heard of him, but he's managed the Fidelity Contraband Fund now since 1991. He's on pace for a 41% return in 2024. That outpaces, of course, all of the benchmark indexes, but it outpaces also all of his peers.
And this is a mutual fund.
It's a mutual fund.
I mean, this is not the kind of return you expect with a mutual fund, right?
I know, and that's what kind of raised eyebrows. I mean, we're not talking about the most active of activist investors here.
Yeah.
We're basically just talking about a guy who's slow and steady picking stocks, and apparently he's picking the right stocks, and more importantly, he's picking them at the right time.
And it was interesting when I was reading the article is that apparently more than half of all the assets in U.S. mutual funds are actually now passive strategies and index funds.
Yep.
So to then have a mutual fund that is active is also rare. And then to perform this well, extra rare.
And it kind of wonder, too, whether Will Danoff is kind of, I hate to say it, it's kind of the last of a breed. I mean, he obviously came up at a time when the mutual fund managers were the stars, and of course all that has changed since the 1991 when he took over that fund. And
in the long run, right, aren't actively managed funds harder to beat in the long run?
Yep, absolutely.
Yeah. Anyway, it was a great article. You should check it out. 41%, nothing to sneeze at for this year.
Nothing to sneeze at. I'm sure I would take it as you would. When we come back, though, it's going to be a hard to tariff a good time. That's the word over at Barclays, which has a new note out on U.S. travel and leisure stocks. It's coming up next in our top calls. This is The Close on Bloomberg. All right, let's get to our top calls. The big movers on the back of analyst recommendations. And we're going to start off today with Broadcom. A broad-based chips rally on the day here after that company's quarterly results beat a key metric, which in turn propelled its market cap above $1 trillion for the first time. Bank of America lifting its price target to $250 from $215, citing surging AI opportunity for the company as a custom chip leader. Those shares having a phenomenal day, up 25%. Next up, RingCentral, a neutral rating for the cloud communications platform over at Mizuho, a price target at 42. The company recently announcing a shift in its contact center strategy that the analysts say could pressure subscription revenue growth in the near term. Shares down 7%. And finally, Penn Entertainment, JP Morgan raising its recommendation to overweight from neutral. The success of the ESPN Bet licensing deal being a big driver for the stock. The analyst saying segment EBITDA not priced into the shares just yet, and he also believes a lower interest rate environment will result in incremental M&A opportunity. Shares up 3% on the day. Those are some of our top calls, and we do want to stay in the gaming and leisure space because a new note out from Barclays says a re-energized consumer will do wonders for the travel, gaming, and lodging sectors. An upgrade for Marriott Vacations, an upgrade for Norwegian Cruise Lines to overweight, while moving to neutral on Hilton Grand Vacations and Viking Holdings. Brandt Montour joining us right now, equity research analyst over at Barclays. Let's start with the cruise line, specifically Norwegian. I feel like the cruise lines just can't be beat. Every time we say the rally should end, every time we should say people will stop cruising, it never stops, Brandt. This seems like the biggest moat there's got to be in the equity space right now.
Thanks for that. Yeah, we do like the cruise lines again for next year. I mean, when you think about this recovery, I think we're in this sort of 6th or 7th inning. You know, the first, second, third inning was back a couple years ago when we just had to make sure they didn't have to raise more capital. And then the third, fourth, and fifth inning was really the last 18 months where there was this big deleveraging of the balance sheet and shift from value from the debt to the equity holders. And now we're sort of in this really kind of a pure equity story where we see tremendous pricing power based on really great demand and supply dynamics, excess demand leading to strong pricing power, and low supply growth being supportive. And so it's really a bottom line driven story from here.
I am curious when you look at the travel industry overall, because I think it's interesting kind of what you upgraded and maybe what you didn't. The idea is that maybe we do see some softness in consumer spending overall, at least to the point where consumers have to be more choosy about what for most of us is the ultimate discretionary item, a vacation. Is it a trade-off between, say, going on a cruise versus going to a resort on land? Or is this going to be everybody either benefits or everybody gets hurt?
Yeah, no, I think it's the first one. So, when we came out of COVID, prices went up across the board for all of travel. But cruise lines sat out the first 2 years of that recovery because of the CDC guidelines and that they really couldn't operate freely. And so cruise prices are up probably 15 to 20% above 19, but that's not even in line with inflation. We see U.S. resorts on land up 25 to 35%, and prices in the Caribbean on land up 50 to 60%.
Wow.
So that delta in terms of that price still means that cruise is a really good value on a relative basis today, which is why, like I said, they're seeing that outsized demand.
Overall, Bloomberg Intelligence had a great survey out, and they did a travel survey. It said 72% of U.S. vacationers plan to increase travel spending next year from this year. And they said overwhelmingly it was things like cruises, it was all-inclusive vacations, kind of like pay it, forget it, and set it kind of thing. Do you see something similar from that respect? And who wins in addition to the cruise guys?
Yeah, I think that, all of 24, it was really, leisure was holding up, but it was not really growing very fast. Cruise had its own sort of supply and demand dynamics and was doing really well. But, lodging, like weekend travel for hotels was sort of flattish. And so I think, it was really the American consumer kind of like catching up with the revenge travel of the prior years and just really tough comparisons to grow into. And so really the question, that was kind of how we thought about next year until the election. Mm-hmm. And so the real question about is how did the election and the outcome of the election change the general mood for how consumers view the economy and how they view the sort of lack of uncertainty in the economy. And I guess we'll see. So far, since early November, every single one of our subsectors has seen an incremental shift positive in the sort of trends that they're citing. So we've already seen the feet move on the ground from the consumer in the leisure travel world, and we'll see how that continues into 25.
Wow, that's amazing. All right, Brandt, thanks a lot. Brandt Montour over at Barclays joining us there. Just that sentiment, that feeling, whether it's consumer sentiment, small business sentiment, CEO sentiment, just all seem to be skyrocketing into next year.
What's it going to take to get you on a cruise, Alex Steele?
Absolutely nothing. I'm that kind of person that, I don't want to be around people. You know what I mean? I don't want to sit with strangers. Please, you wouldn't go on a cruise either.
You chose the wrong profession.
Yeah, I know.
No, I've never been on a formal cruise either. But it gets to this idea. But I've heard this idea that the value proposition actually stacks up in favor of cruising versus that. But, I'm like you.
20% less from on land, that's significant if you're budgeting. But
then you're on a boat
with people you don't want to be on. All right. Anyway, luxury real estate back in business. We're going to talk about what's going on in New York City coming up next. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Alex Steele. Let's talk about one area of the market that could see a real uptick if the Fed continues to cut and will be very exposed if they actually don't cut as much as we expect next year, and that's going to be real estate. And we talk about commercial real estate, but then there's actually luxury real estate, which you might not associate with being super sensitive to like a 7% 30-year fix, but actually it is.
Yeah, I would think so. But it was interesting, too. Bloomberg was reporting today that at least here in New York City, the luxury real estate market has seen quite a bit of a rebound just over the last couple of months. They're talking about 90 contracts signed last month for homes that were worth they had selling prices of $5 million or more. I know you were probably one of those people. Right?
No, you're the one looking.
I know, I was looking.
I have a 2.75% 30-year fix.
Look at you.
Girl dying
Don't
in this
brag.
apartment, okay? But anyway, we want to get more on this and sort of what is the forecast then for 2025, particularly if we see a little bit less hiking cycle from the Fed. Francis Katzen is founder of the Katzen team over at Douglas Elliman Realty. How's it been for you the last few months?
Bonkers. It's been really busy.
Which months were busy? Where in the space? Tell us more.
I think it was a mixture of an election being solidified, compounded by rates that were reduced by 50 basis points in October. And in fact, In November, we saw 246 contracts signed for that month, which was the third highest in the past decade. And just last week, we saw 37 contracts signed over 4 million, which is the entry luxury. That was 15 more than the week prior, and 13 of those were over $10 million. Wow. Yeah.
So what is your take on that? I know you said the election, but when you say 4 million, I'm like, are they really getting their 30-year fix? Like, is it that much sensitivity to what the Fed is doing?
I would have to say one of the most staggering insights as a broker on the streets that I observed this entire year was when the rates were hovering at 7 and 8, we literally saw between 4 million and 4.999 a 53% reduction in trade.
Wow.
That was really staggering because you think luxury entry 4, who really needs the leverage, they did. It was very interesting.
Where are they buying? Is it in sort of the typical pockets that we normally think, or have they fanned out to sort of places that we don't know about?
Well, I think
he's asking for a friend, by the way.
Well, it's actually interesting that 240 whatever, you had 129 in Manhattan and 96 in Brooklyn.
Yeah.
Which was interesting. That's a very different number. I think it was only 53 the year prior, year to date.
And for our viewers who maybe aren't familiar with the New York real estate market, in the old days, Brooklyn would be kind of the bargain.
Section.
Yeah, that
right.
was the bargain. And now you're seeing a lot more high net worth individuals, celebrities, of course, move into neighborhood, Brooklyn Heights, where she lives, or we're out in Brooklyn. But in all seriousness, it gets to this idea, though, too, of this activity. Was this just kind of a catch-up, meaning all the activity that would have happened early in the year now is just flooding into your inbox at the end of the year, and then that's it? Or is this kind of an uptick of momentum that we're going to see into 2025?
Boy, I wish I had a crystal ball. I would imagine it's going to continue. I think if there is this prediction of additional rate drops maybe 4 times throughout the year, I think it is meaningful. And I also think the capitulation in the sales market from the stagnation has made it such an opportunistic diversification.
Maybe you can't answer this question, but this gets to the whole idea of interest rates as well. What about sentiment? I mean, how much are your clients affected by just broader sentiment about financial markets and the economy? We've been talking a lot about how sentiment has shifted given the outcome of the election. There's a certain, obviously, class of people in this city that think good times are ahead, economically speaking. And I wonder how much of that maybe could have fed into the increase in real estate activity.
I think that's a really great question. I would also say that the earnings reports from Goldman and Citi didn't hurt. They actually performed. They outperformed. And I think that had a bit of a trickle impact into the malaise lifting. I also think, I think diversification is part of how you make money, and I think real estate does that. Well,
and to that point, we should point out, we've been reporting bonuses are supposed to be incredibly high this year, so I think come February, you might see a lot more activity.
Well, actually, but that's not a terrible point. And you also had then the crypto, the rally there. Some random meme stocks are also doing well in random moments, and then the equity market continues to be on a tear, even if we have days like this where we don't go anywhere fast. What do you expect, though, if we get just 3 basis point cuts? 3 cuts from the Fed next year rather than 4? Like, does the number matter, or is it the trajectory that really matters?
It's the trajectory. I think people psychologically can bite down on a higher rate if they know that it's going to reduce a little bit. I think also the discussion of SALT deduction helps.
Oh, yeah.
That's a big one for
Even if it's just 20 grand?
I was just going to say, it doesn't seem like a lot, but you know what? That's 40 grand pre-tax. So it's meaningful. It all adds up. Inflation is not fun. Everything is expensive.
Inflation, that's actually the best. Inflation is not fun, period. There we go.
It's not fun.
Okay, so then give me a sense of what kind of things are selling. I know luxury, but are we talking brownstones? Are we talking new buildings with super high amenities like a pool? Is it old buildings that are retrofitted?
The new development market has performed extremely well. I think the buyer pool has had more demand in what they want for their lifestyle. It's normally a home office, more sort of, green design, more mental health, sort of experience spa level amenity type of product. The new development has been very strong because they've been able to offer newer product with more amenities. But in terms of the resale, I think it's still holding. I think it comes down to absolute price.
Francis, I do have to ask you a little bit about the lawsuit and settlement with the National Association of Realtors and how that affects the commission structure for real estate agents going forward. I mean, what's been the adjustment so far since that settlement? And I mean, I don't know if it affects necessarily the type of clients and people that you work with, but overall, for just the real estate market overall, is there going to be a big impact on who stays in this business and who maybe gets out?
It hasn't. I think that there's been somewhat of a revolution to it. It's such a de-incentivizing friction cost that has no upside for either the building value or for fetching a higher price. There's no real smart way to make it make sense. So I think basically the owners are ignoring it and are saying, I'm still going to maintain it. And the buyers are like, thank you very much, because the last thing I want to do is throw that on my back, compounded with a higher interest rate and a mansion tax and any transfer taxes if I'm buying a new construction. It's the most counterintuitive thing you could do to drive an economy, in my opinion.
All right, Frances, we'll leave it there. Always great insights out of you. Frances Katzen there is the founder of the Katzen team over at Douglas Elliman Realty, responsible for, last time I checked, I think at least a couple $2 billion in transactions over the years. And we go from New York to London because there's a big transaction over there. They're building a new skyscraper.
Apparently, how tall is it?
I don't know exactly how many feet or meters, I guess I should say, but it will be the tallest thing in London. And the renderings of it, let's just say it sticks out like a sore middle finger.
No, you think?
It's called the upshaft, right?
Yeah, it
the
is.
The undershaft, excuse me.
Okay, here it is. It's going to be almost 310 meters.
Yeah.
And it's going to have about 154,000 square feet of office space, public gardens, cultural spaces, and restaurants.
Okay.
74-story tower.
Yeah.
I don't know. I mean, compared to like the Saruman's castle in Brooklyn that they put up,
it looks fine. This is what you need to do. Cities evolve, but everyone's a critic, and you know how it works, right? Anything that's new and different, it doesn't fit the old school aesthetic. People are just going to get upset about. Frances, you got something to say about this?
No comment.
But one undershaft is a very weird name. But
it is.
It's okay. Yeah, she also agrees. She has something to say.
All right. We're going to take a quick break here as we continue to count you down to the bells. We're just about 20 minutes away. We're going to check in on shares of Restoration Hardware having a phenomenal day. Maybe it's all those folks buying
because you got to furnish the luxury apartments.
Yeah, and where better else to do it than Restoration Hardware. That's coming up next is our stock of the hour right here on The Close on Bloomberg. All right, one of the best performing stocks of the day is Restoration Hardware. Up right now about 18% to its highest level since 2022. This after the company raised its revenue forecast. The furniture retailer also swinging to a profit in its most recent quarter, with a lot of analysts now talking about accelerated demand for the company's products. Abigail Doolittle joining us right now to talk a little bit more about Restoration Hardware. This was kind of a star stock, a star company for a while. It kind of hit a few speed bumps over the last year or so, and I think a lot of people seem to make the connection to the lack of home sales. The idea that if we're not buying homes or buying new homes or bigger homes, then you have no reason to be buying RH furniture. We were just talking to Frances Katzen over at Douglas Elliman, and she said she had a pretty good November, so maybe that could bode well for RH.
Maybe that could bode well for RH, and maybe it did bode well for RH in terms of, the lag time would be a little bit different, but it would be consistent in terms of their November. They saw amazing growth, I think 27%. December, right now on track for 30% growth. Mm-hmm. It's interesting that you were mentioning some of the speed bumps, because that's a piece of this story. So in the beginning of the year, they put out this crazy high guidance, and people are like, oh, are they going to be able to return to this type of growth? Then in the second quarter, they didn't deliver. They had to cut guidance, so people thought, well, they weren't able to deliver on the growth. And then they actually, in the third quarter, the growth that they put up was what they originally forecasted, and now that they're saying in November, which was even better than the third quarter of 27%, 30% for this month, people are thinking, okay, maybe they can do it. So I think that that's a big piece of the story. Maybe earlier this year, they had execution problems. It could also be the housing market, as you're talking about, fewer homes and new homes. Plus, the prices are really pretty high. So we are talking more about luxury homes, luxury.
Of course they do.
They certainly have sales.
I'm actually looking at their couches right now, currently, as we speak.
Those are some pretty interesting shades of brown you have on your computer screen.
It's the whole gamut.
Do they have colors?
Yeah, they do. Okay.
You were just in the neutrals.
I was in the neutrals. Okay. I mean, I'd love a forest green velvet couch, but my husband will veto that hard. Anyway.
You know who has a great forest green?
What?
Have you ever been to Room and Board?
Yes.
They have this forest green velvet couch that I wanted for years.
And did the wife?
Unfortunately.
Nix that?
Fortunately, I have other people. I have other people in my household who also get a say in these decisions. So
so rude when they do that. But so Abigail, I guess I'm trying to get to the fact of what is the macro versus what's the execution versus what is a sort of idiosyncratic retail sector part.
So I think that a lot of this is actually very specific to Restoration Hardware, or RH, in terms of what they've actually done, something that I don't know of any other furniture store doing. They've refreshed 80% of their product. Wow. So if you were a big RH person 2 years ago and you now get the calendar, it's 80% different. So that's why they brought the guide up. So analysts think that big product refresh is really going to help them. The other thing is, now weigh in on this, they want to be the true luxury furniture provider out there, and they are seen as being above Ethan Allen, and then they're also seen as being above Williams-Sonoma. It's interesting, Williams-Sonoma, their November not great like this, but they want to be the Gucci of furniture.
Well, and they've been clear too. I mean, they're sort of pushing to experiences, obviously, with their restaurants and hotels, and this idea of sort of creating this kind of community, if you will. I mean, if you want good prices there, you have to be a member. It's, you know,
and it's like by $4,000.
Yeah, it's a lot.
Yeah,
and I remember when they first really went down that road, I was kind of like, why would you do that? But you saw it really pay off in the numbers on a quarter-to-quarter basis, and now you look at where they're sitting now. I don't know if you read the CEO's investor letter.
I do not.
It's bonkers, and you should read it.
Bonkers how?
Bonkers in a good way. But he has a vision.
He has a vision.
Yeah, and it's not like your typical, you know, we'll increase EBITDA by X, Y, Z.
Well, it's interesting because even though RH is above my price range, it seems super expensive, but it doesn't seem like the Gucci. So I think that they do have some work to get there. Maybe they're going to create some sort of premium level where those products are, you know, say that much more above. But with this 80% product refresh, these super high products that they put in there, it seems like they're on their way.
All right, Abigail, thanks a lot. Really appreciate it. I'm going to keep looking at those couch colors. Coming up, we're 15 minutes from the closing bell right here in New York. This is Bloomberg.
Exporters are going to do great. Well, they should, but not if they're getting tariffed, which they very well may be. So there's a lot of second and third order effects next year when we think about these government policies and the markets and how they're feeding through. That's going to make it an academically rigorous year for investors.
Rebecca Patterson kicking us off to the close just about 50 minutes ago. Of course, she's had a lifetime on Wall Street, JP Morgan, of course, Bridgewater, and just the general sense here that she is relatively optimistic. I mean, although she's seen a lot of risk out there, but she was still relatively optimistic about the potential continuation of the rally.
As long as you're academically rigorous, because you got to take into account if you're buying overseas and then the exchange rate, and that got Romaine and I a little scared. But talking about not rigorous, and that's what we're seeing in the market today. Honestly, nowhere fast on the major indices. The semis, though, really outperforming. It's kind of a mixed bag, right? Because obviously you have Broadcom doing really well, but then on the flip side, Nvidia is down a little bit, but nonetheless, the stocks index outperforming there.
Kind of interesting to see, though, the S&P finally really trying to kind of poke into the green here. It kind of did it right at the start of the show. Straddling the line is still going to be down on the week unless we get a massive rally in the next 9 minutes or so. But again, the reason why you're seeing the S&P in the green is because of the stocks. I mean, that's a really Broadcom really kind of driving this here. That's the biggest point contributor in the S&P, 23 to 24 points of that in the S&P right now coming from Broadcom. Richard Weiss joining us right now. He's CIO of Multi-Asset Strategies at American Century Investments. He joins us right now to count you down to those closing bells. And Rich, I mean, there's been a lot of talk, I think, about this rally or whatever we want to call it these last week or so, and whether this kind of continues into 2025. And I just want to start off with kind of a simple question about valuations, because while everyone's, focused on the neutral rate and what Jay Powell sees, I am curious about fair value in the equity market, even independent of the Fed, and whether we kind of reach fair value, at least on an aggregate basis. And the price action that we've been seeing over the last few weeks is really just kind of the market trying to come to terms with that.
Yeah, no question. A lot of this move in the last few weeks is not necessarily earnings based. It's PE multiple based, and so valuations. Where's the S&P? Somewhere around, I think it's almost approaching 30 times earnings, last 12-month earnings. So the market is now priced in near perfection. Very little room for disappointment next year with what the political agenda and the new policies bring us. And if you compare our valuations to virtually any other equity market or yields around the world, at best fairly valued, more than likely overvalued in the U.S., which is, it screams for diversification at this point.
What does diversification, though, look like in this environment, looking forward to 2025?
Get outside the U.S. If you look historically, anytime an equity market has outperformed, as we have over a decade, the probabilities of that reoccurring are nil. Matter of fact, most of the time that equity market tends to be in the bottom third. in the world rankings. So historically speaking, not likely we're going to continue to outperform to the extent we have. We like equities, we're neutrally weighted, but diversification is key here. Some of those European markets, granted, their economy's not as strong as ours. We continue to be the world's global economic locomotive. But those markets are undervalued relative to ours. Emerging markets, another case here. Typically, emerging markets, Romain, as you well know, outperform developed markets, right? They're smaller, they have faster economic growth in their markets, typically outperform by 10% or more on an annualized basis. Over the last decade, it's been the reverse.
Well, Rich, does that imply then that I know you're neutral on U.S. equities, but if you're going to go more into value, does it also imply value here in the U.S., or you want to get that value really in Europe or EM?
No, exactly, Alex. With value here in the U.S., we have been diversifying within our U.S. equity portfolios, thankfully, in terms of size and style, specifically smaller cap and value. And that's been a nice place to be, during this post-election bump. So definitely diversify. To the extent you've been fortunate enough to have reaped some of those profits from the Mag 7 or just being in the S&P, now's a great time to take some of that off the table. Well, maybe you want to wait for the new year to take the profits for tax reasons and redeploy that, again, across size and style and outside the U.S.
What do you make of the fact, though, that the rotation into value and like a mid cap and small caps, like it hasn't been consistent? I feel like every few weeks we get this is the moment, this is the time, and then it doesn't actually materialize in a meaningful way. What am I missing?
Well, I don't know. I'm missing some of it too. Okay, but the political agenda clearly is taking center stage. A lot of the arguments for small cap or mid cap and value, and the banking sector in particular, depends critically on what, if any, of these proposed policies the incoming administration is going to be able to get done. Certainly the immigration and the tariffs, that's executive order that could be done on day one by the president. But tax cuts, some of the other protectionist policies, which would clearly favor small cap stocks, value stocks, banks in particular, it remains to be seen whether we're going to be able to implement those and whether they'll really benefit those sectors.
I'm curious, this kind of brings us the question then too about what sort of safety the fixed income market offers at this point. Obviously, there's a lot of activity right now in the Treasury space because of bets on where the Fed's going to go, but you still have a lot of money in T-bills and short-term cash effectively. You still have a lot of people in short duration fixed income. I don't see as much buying when you get out to 10 and 30 years, but that could change maybe given the recent disinversion though that we saw on that 3-month 10-year yield.
It's possible, although we're shying away from extending duration. I mean, given the potential for inflationary pressures due to, again, the political agenda, deficit finance, tax cuts, or draconian immigration or tariff policies, these could be inflationary, driving up longer term yields. So we're content to stay short in fixed income. And also, to your point, two other inflation hedges possibly have been and remain precious metals, which have done so well this year. And I'd argue Bitcoin is potentially an inflation hedge. It's a dollar hedge, inflation hedge, along with cash.
Yeah, absolutely. Well, I mean, you certainly can't argue with Bitcoin. And I could just tell you the other day, I was taking a look at some of the year-to-date returns in the commodity space. And gold actually setting up, so at least on the spot basis, one of its best years in decades. Richard Weiss, got to leave it there, man. Always a great conversation. Have a wonderful holiday season. Richard Weiss, CIO of multi-asset strategies with American Century Investments. Alex? 0.1% on the NASDAQ composite right now, 0.8% on the NASDAQ 100. And that's pretty much all the good news in the equity market right now.
Volume's really light. We do have a bunch of 52-week highs, though, 27 52-week highs. And it's kind of broad. It's Broadcom, it's Marvell, but it's also C.H. Robinson and also RH. So it's like a really weird combination of like retail, freight, and semis.
Yeah, of course, the idiosyncratic trade was sort of a big topic of conversation in 2024. Promises to be next year as well as we break down all of the market action on the day and on the week. That starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you through that closing bell with a global simulcast that starts right now. Scarlett Fu in the TV studio, Carol Masser and Tim Stenovic in the radio booth. A hearty welcome to all of our audiences across all of our platforms. Here on this Friday afternoon, a slightly update here for equity markets. If you're looking at tech stocks, if you're looking at anything else, well, it's a lot of red on the screen.
Yeah, there is a lot of red on the screen. I've been looking at kind of the S&P 500. Most names in the index are down. I do feel like, yep, yay, Broadcom. That certainly has lifted that group. But I think we're already looking ahead to next week in the Fed meeting.
Yeah, but if you look at the stocks, even though the stocks is up 3.3%, thanks Broadcom,
Not
thanks
every
Marvell.
name is up.
Exactly. AMD is lower, Microchip Technology, NVIDIA, Intel on. So we're not seeing enthusiasm across the sector.
If you think Broadcom's having a great day, take a look at what Avago's doing right now.
I hope it's one of Carol's gainers.
That's very funny.
Thank you, Carol Masser.
That's a throwback there, Romaine.
There are like two people who got that joke.
No, I got it. I was making fun of myself.
You just didn't think it was funny.
No, exactly. Because on radio, I was like, wait, why did they change their name again? Yeah, anyway.
Avago was always a little bit curious in terms of like, what did it actually mean? You talk about the growth stocks and how it's kind of uneven. You look at growth stocks as a whole versus value stocks, and that gap between them is now at the widest since 2021. There's been some work done on this, which shows that in the past, getting to this level tends to trigger a reversal. I don't know if next week and the Fed meeting might be the catalyst for that reversal.
I mean, maybe, but, you have to wonder. I mean, I'm sure everyone's going to be trading the Fed, right? But that at 3:01, everyone's putting in their stops and going home for the holiday weekend.
Yeah, it'll be interesting to see. Obviously, we see the positioning around it right now. It'll be interesting to see exactly what happens when we get to that actual date. Meanwhile, here on this Friday afternoon, a wrap up here on the day and on the week with the Dow Jones Industrial Average down about 86 points or 0.2%, and that gives it a decline on a weekly basis of roughly about 2%. The S&P, we're just going to call it unchanged on your screen there. It's going to settle in right around 6,051, though it is going to be down on the week by about 0.6%, snapping 3 straight weeks of gains. The NASDAQ, though, continuing its winning streak for a 4th straight week. The composite up about 24 points or 0.1%. On a weekly basis, up about 7 to 0.8%. And the Russell 2000 down on the day and on the week on the day, losing about 0.6%. Carol.
All right, just want to mention a headline crossing the Bloomberg terminal. Supermicro said to consider raising some equity and debt, said to tap Evercore to raise capital. So some news just coming after the closing bell.
Yeah, we actually see the stock moving significantly, down 7% in the after hours, just after this was reported. Once again, Supermicro Computer said to tap Evercore to raise capital, said to consider raising equity and debt.
Yeah, this is after Supermicro had lost about 4 days or declined for the last 4 straight days. All right, let's take a look at the IMAP. You can see some green, some red, but notably the green, very few and far between. Tech, consumer and discretionary, each up, but only by 0.4%. The big decliner of the group is communication services. So a split there in those growthy names. Communication services down more than 1%, mainly on weakness in streamers like Paramount and Warner Brothers Discovery. Materials and energy, commodity type names also lower today.
All right, let's get to the name that we all talked about a lot on this Friday. We're talking about Broadcom. As we know, the ticker AVGO. Doesn't seem like it makes sense, but if you understand the history of the company, thank you, Romaine, we do understand it. The stock up about 24% here after the close, hitting a record, also surging to a $1 trillion market cap. So really a blowout day. First, hitting that market valuation for the first time. Top gainer in the NASDAQ 100 and the S&P 500. Earnings coming out, predicting a boom in demand for AI chips. So some really strong numbers, especially when it comes to the outlook. We got a lot of context on the call last night with analysts, and so that one was really a standout in today's session. RH, let's go there. This one also an outperformer, up almost 20% at its highs today, finishing the day with a gain of just shy of 17%. Stock is up more than 50% here in 2024. The company raising its revenue forecast for 2025, swung to a profit in the third quarter. TD Cowen raising its price target to $500 from $380. Stock closed at $446 and change. Morgan Stanley, Baird, Jefferies also raising their price targets. And Alex, I know you like to shop there.
Oh, I wish. I was just looking at their couches. I really did like some of their colors, but for $16,000,
it's all big and it's all expensive. All right, Walgreens Boots also one of the top gainers in the S&P 500, guys, up about 7% here. Sycamore Partners arranging debt funding for a deal to buy Walgreens Boots alliance with B of A, JP Morgan, and Wells Fargo. Among those asked to help finance the deal. This was all coming from Sky News, a report out. They did not cite where they got the information, but nonetheless, this was definitely a strong performer in the Friday trade.
All right, you got the gainers, Carol. I got the decliners, and not every company in the chip space surging today. NVIDIA down for a second day in a row. It's actually down close to 10% from that all-time high back in the earlier part of November. Today falling 2.3%, still up 170% so far this year, but among the most actively traded stocks today. Novo Nordisk shares fell in Copenhagen today to close lower by 4%. Here in the U.S., ADRs fell by 1.5%. The company's blockbuster Ozempic was linked to an increased risk of a rare form of vision loss. It's in a study that backs up Harvard University research that was published earlier this year. The study wasn't able to determine whether there was a similar impact among people taking Wegovy, which is Ozempic's sister drug for obesity. Shares again today, ADRs, I should say, fell by 1.5%. And then Charles Schwab came out today, and they raised their full-year revenue growth forecast on optimism around investor engagement and strength in the equity markets following the U.S. presidential election. Still,
so why are the shares down?
Investors fell. Investors sent shares lower by 4%. Some analysts said that they even they missed their own estimates and that they were mixed. But Schwab did say that, and this makes sense in a lower interest rate environment, customers are keeping their cash on the platform for longer. They're not moving it to those higher yielding savings account. So that's been a boon for the company. You remember those issues that they had back in 2023 as a result of higher interest rates outside of Schwab's platform. So they're keeping their cash at Schwab for longer periods of time.
Yeah, because those higher yielding savings accounts are more like yielding saving accounts.
I'm getting a lot of emails saying that that your interest rate's changing.
Yeah.
They're not saying it's getting lower, or the yield is getting lower. They're saying it's changing.
Oh, no, mine is. My yield's definitely getting lower by a good 100 basis points so far.
Lower.
I haven't moved it.
It's changing. They're using the word change rather than
thinking about where to move it.
Okay.
Anyway, I
digress. You and everyone else.
But Alex, here is why maybe that rate should go up.
Does Tim work for these banks or something? Because he seems to be defending them.
He knows a lot.
He's hedging a little bit.
I got accounts all over, Romain.
Okay, I'm going to yields because speaking of, I want to talk about the bond market because honestly, aside from Broadcom, the bond market was where the action was today. You saw a sell-off all across the curve, particularly in the back end. I should point out that for the 10-year yield, the whole week you've seen a rise about 25 basis points for that 10-year. And if you look at the technical pattern of the 10-year, we're in a golden cross, you guys. And that means the short-term moving average is above the long-term moving average, and that usually is a bullish signal, which means something because then you're going to shake out positioning, and does that have a knock-on effect when it comes to equities?
And just want to point out, too, on that 10 and 30 year, this is actually the biggest jump that we've seen in yields on a weekly basis all year long.
Since October of 2023.
Yeah.
This is the most that it's moved. So it was something.
Look at it now, right? Because it could change next week with that Fed meeting. So we'll see what happens. Hey, guys, one of the things that, I should say Tim is obsessed with.
I know Romain is obsessed with this story.
Romain, we're doing this story just for you.
I don't know what the story is.
Oh, gosh.
Has to do with some drones over in New Jersey.
Wait. Who here among us lives in New Jersey?
That's just Carol raising her hand.
Have you seen these drones?
No, but I haven't really been looking for them either. I work a lot, and by the time I get home, it's dark.
Okay.
That's when they come out. That's when.
So, Carol, you're not concerned at all about all this alien life hovering over your house?
I'm not concerned. I'm not concerned at all.
All right, these are mysterious drones. They've been spotted flying over New Jersey. They sparked concern and conspiracy theories among residents and lawmakers. You even had Senator Andy Kim doing a. What do you call it? It's not a tweet storm anymore.
He wrote with the police.
He went out with the police.
In all seriousness, one thing I am curious about, and also because they say that a lot of these objects, we'll just call them, are hovering over also not just over houses, they're hovering over police stations, infrastructure, power plants, things like that. And I think that's where some of the alarms coming in. But it raises the question as to why haven't we gotten an explanation on this?
Well, U.S. National Security Council spokesperson John Kirby said today, quote, yesterday, it appears that many of the reported sightings are actually manned aircraft that are being operated lawfully. So he's saying they're just planes.
We talked to Nick Wadhams, right, who follows security here at Bloomberg, and he said
Can you see me squinting my eyes in a skeptical fashion?
He said eventually they're going to have to come out and say something just because it's getting so much attention. But it could be government, it could be corporate, like there's a lot of
corporate
possibilities.
Or maybe it's
do corporate
aliens.
jets just hover over, critical infrastructure?
Companies use drones to check out their facilities. Absolutely.
Okay.
Right, then just say that.
Then why haven't they said that?
I don't know.
What are they hiding?
Okay, see, it's a good story.
Maybe it's all for some TV show. Maybe like some TV producers are creating some reality show, and this is all part of it. And we're going to get some great visuals at the end of the day.
TBD.
Yeah.
TBD.
Okay.
Well,
None
you know,
of
speaking-
you have ever been to the movies because this never ends well. It always starts just one thing in the sky, and everyone's like, "Oh, isn't that cute?" And then
But see, it's
2
the beginning
hours
of a
later,
great story.
we're all,
We knew Romaine would love this.
slaves to the grok.
Speaking of TV shows, you guys, anyone watch The Hot Ones?
Oh, it's a great show. Yeah.
You guys are all fans?
I love these chats. Who picked these chats today?
I think we all did. BuzzFeed has sold the company behind The Hot Ones to a group of investors.
They sold it? Isn't that all BuzzFeed has?
Well, now they have $82.5 million.
Oh, wow.
So there's something.
Okay.
Well, they had to pay down some debt, so this was cash going towards that. But who is this one? This is Steph Curry. I think the
Steph
best
Curry.
one was
There's
with
Lenny
Conan
Kravitz,
O'Brien.
John Mulvaney, right? Is that who that is? Yeah.
Yep.
I don't know who that is.
We did a live Hot Ones.
Yeah.
Out at
we heard
the Screen Time.
Yeah.
You did?
That was really cool.
Yeah.
Well,
Oh, that's fun.
Oh, wow.
How'd that go?
Branson.
We didn't do it. We just heard
Cool J.
screaming while we were on air.
We were right
Essentially.
there.
They were right behind us. So
It was
there
pretty cool
A
at
lot
the
of
Screen
sound.
Time event in October.
Yeah.
Yeah.
Wow. Jake Gyllenhaal.
Hey, Romaine, be careful. I think that's a drone above your head.
Oh. Well, I don't know. Honestly.
He's okay with that.
Yeah, I could use the break, Okay. take me up there, do whatever you want with me.
All right, we got to go. Stay safe, stay warm, guys. We will see you again. Same time, same place.
Alex, you got something to say?
I got
Maybe Alex and Scarlett will come back. That's all I'm going to say. Have a good weekend, guys. We'll see you on Monday for the closing bell.
And we continue our coverage right here on Bloomberg Television. The markets right now largely in agreement on what the Federal Reserve plans to do at next week's meeting, a 25 basis point rate cut, but a big question here about the rate path ahead for 2025. We'll seek some answers out of Julia Coronado and Macropolicy Perspectives. That's coming up next right here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Definitely Friday vibes here, at least in studio, not necessarily in the market. I want you to take a look over at the board behind me because that unch really kind of sums it up here. A bit of a holding pattern ahead of what could be a big week next week, the last Fed meeting of the year, and then probably everyone just goes on vacation. But what you are noticing here at 6,051, it is a rally that has stalled. 3 straight weeks of gains for the S&P coming to an end here. The NASDAQ did extend its winning streak for a 4th straight week, and that was largely because of a big boost by the chip makers. The Philadelphia Semiconductor Index lifted by Broadcom today, helping that index move higher by about 3%. Both the Russell and the Dow down on the day and on the week. Your 10-year camped out around 4.4. And I guess if you are bullish on the crypto space, Scarlett, you got to be happy with what you saw this week. Not a whole lot of activity in Bitcoin, but the idea that it's holding at that $100,000 level, key for a lot of folks.
Above that $100,000 level. Maybe that's boosting MicroStrategy, but there's also some other developments at play here too, because MicroStrategy and Palantir are reportedly some of the names that will be added to the NASDAQ 100 by the NASDAQ as part of its annual reshuffling. At least that's according to the economists and analysts over at Bloomberg Intelligence. So those stocks moving higher in trading today, despite the overall unchanged nature of the S&P 500. Lamb Weston gaining almost 7% on the day on a report that cereal maker Post Holdings is working with investment banks to look into a way to buy the frozen French fry maker. Of course, Lamb Weston under a lot of pressure from activist investors Jana Partners. And Broadcom, the big winner of the day, up 24%, now has a $1 trillion market cap following in the shadow of NVIDIA after predicting a boom in demand for its AI products, specifically 65% growth in AI product sales this quarter alone. So that brings us to our top story this hour. Chip-related names, clearly the bright spot in an otherwise meh day and down week for equities. Companies are tripping over each other to position themselves as beneficiaries of the AI spending frenzy, whether that's making parts to build out data centers or creating agents to handle multi-step tasks or providing the electricity to power large language models to sift through text and create new content. As investors continue to search for potential winners, we'll also look at the other side, AI's error rates and the rising costs of that, too.
Yeah, we're going to talk to Jana Eggers over at Nara Logics in just a second because, of course, the AI story, and as you just saw with Broadcom up on the screen, a big part of the story this week. A big part of the story next week, though, is going to be the Fed. We're keeping a close eye here on the Fed's rate cut decision, the last one of the year. Bloomberg opinion columnist and senior advisor to Bloomberg Economics, Bill Dudley, telling Bloomberg TV earlier today that he expects at the next 2 Federal Reserve meetings.
Powell talk about how, inflation is a little bit sticky. The economy is doing really well. You'll probably see some upward revisions of the Fed's estimates of so-called R-star, the neutral rate. So I think all those things together will make it pretty clear that, January is probably going to be a pause. And that's really what's priced into markets. Markets are very certain about December being a cut, and they're pretty certain about January being a pause.
Bill Dudley speaking a little bit earlier on Bloomberg Television. Joining us right now on the big program, though, is Julia Coronado. She's president and founder at Macropolicy Perspectives. And she's also expecting a 25 basis point cut at the meeting next Wednesday. The big question, though, Julia, as we get into January and March and May, et cetera, what do you think that dot plot's going to look like? Is it going to be as aggressive on some of those rate cut expectations as the last dot plot that we saw?
No, I think that will be the hawkish element of the cut. So the hawkish cut is the very prevalent expectation, ourselves, most market participants, and the hawkish side of that comes with the dot plot that will remove some of the, at least one of the cuts. We just actually hot off the presses, our survey of market participants shows what we expect, which is 1 cut to be removed from the baseline. They were saying 4 cuts in September for 2025. We expect 3. But that irregular pattern also is, an important signal to markets that it's not going to be something like every other meeting. Mm-hmm. We're in kind of uncharted territories. We're at a potential inflection point in policy. So we're going to take our time. We're not going to mess with the progress that we've made to date on inflation. Mm-hmm. So we may hold our fire for a little while, and it may even be beyond March, depending on the flow of the data.
This gets to a big question here about that neutral rate, where you have basically a policy rate that doesn't either, goose the economy or hamstring it. We actually wanted to play another quote by Bill Dudley talking about that, but it got a little into the weeds with R-star. So I'm wondering if, in layman's terms, Julia, and I know you're smarter than all of us, but in layman's terms, when we talk about a neutral rate that, at least based on the last dot plot, seemed like it was going to be around the 3.5% or so level. Do you think that is still going to be their general target? I know it's elusive, but they kind of have to have some idea of where they want to go.
Yeah, and I think that it's possible we continue to see some upward drift in R-star in the long run rate. Whether that exactly matches the terminal rate in 2026 or 2027. I think we're in a range that's somewhere around 3 to 3.5 seems like the landing point right now. But, Chair Powell's always very adamant about saying, who knows? And we're just going to have to feel our way along that path.
And we'll know when we see it.
R-star as a concept is like, what does long run even mean? Is long run 2 years from now? Is it 3 years from now? And what does it mean when you're shifting fiscal policy under our feet, right? So it's not necessarily the guide for policymaking that it's made out to be.
This is becoming very philosophical very quickly. Julia, what is the Fed more worried about at this moment? The labor market and specifically the unemployment rate, currently at 4.2%, but it got really close to 4.3%, or the persistent inflation?
So I think that there's a little bit of concerns on both sides, and the statement is likely to characterize risks as roughly balanced, and within roughly, that can tilt one way or another depending on the flow of data and policy development. So in September, it was tilting towards the employment side of the mandate, and they cut 50. Mm-hmm. And now that looks a little bit better, but it, as you noted, almost rounded up to 4.3. So it's not like the labor market is strong. Mm-hmm. It's definitely not firing on all cylinders, and it doesn't look like it would be far from here to see some outright weakness. On the other hand, we've had a sticky run of inflation, and that's of concern too. So right now, you're still in the zone of soft landing. You're still in the zone of, yes, we're kind of close to our dual mandates. And you're really going to have to look at that flow of data and the prospective policy developments to help you decide which is the more prevalent risk at any given meeting.
Well, we'll see how he characterizes it and threads that needle. Julia, always a pleasure to speak with you. Julia Coronado is president and founder of Macropolicy Perspectives, giving us a glimpse into what we might expect at that hawkish cut next week. And Romaine, I think she answered it for us. A hawkish cut means removing one of the cuts baked in for 2025.
Yeah, and I feel like the market's already kind of ahead of the Fed on this. So at least hopefully the reaction won't be too severe.
Dramatic.
Assuming he does that. But then, of course, Jay Powell's got to come out and explain himself and answer a bunch of questions from the journalists.
Multiple times, no less.
He's probably sick of by this point.
All right, coming up on Bloomberg Markets The Close, we're going to speak with Jana Eggers, the CEO of Nara Logics, about the trends that she is seeing in the AI space, including the ascent of Broadcom. This is The Close on Bloomberg.
It had already been a big year for artificial intelligence, but the last 2 weeks made it even bigger. Earnings last week out of Salesforce, earnings out of Broadcom yesterday, and a lot of questions here about just exactly what AI is delivering. It's hogging a lot of energy, and a lot of people raising questions here about error rates. So as we head into 2025, some big questions here is how the industry sort of addresses some of the negative aspects and how that overlays with the more positive ones. Jana Eggers joining us right now, the CEO of Nara Logics, to talk a little bit about this. And I want to start off with error rates, because this has been a topic of conversation for a lot of reasons. But at least for the ones that are exposed to like the normal consumer, we've kind of seen this firsthand. You prompt ChatGPT or one of its competitors with something, and you get a response that clearly isn't correct. What is the effort now in the industry to sort of address the error rate and to make sure that error rate starts to come down?
I think one of the challenges is we don't quite know how to define error rates in advance. Mm-hmm. Think about things that were happening before, like Weiss has been using AI to generate your traffic flow, but you never had that comparison before. You didn't have somebody that was always running in parallel with you to say, oh, that was a bad choice and this was the better choice, right? And you're now starting to see that because people can judge that response. And I think that's the challenge, is that we don't have great ways of really saying in real life, what is going to be the right answer. Mm-hmm. And because we don't have all those right answers defined, and we also don't know kind of when AI should take that chance and be out of the norm.
Well, this gets to the idea, and I'm going to kind of try to dovetail this back to the earnings, because we got Salesforce earnings, and Salesforce made a big to-do about their agent AI product, and Mark Benioff seems to think this is going to be the future, at least for his company. But we've heard other companies talk about this as well. But this gets to the idea, agentic AI is only going to be as good as, I guess, the answers, and more importantly, the task that it performs, and those tasks are done properly.
Right, and I think you're hitting on exactly. You said the key word there, task, right? So look at what happened with the RPA, or robotic process automation, right? And there were a lot of challenges with it. Now we're combining that with AI, and people are expecting it to be wonderful and something new. But I think you're going to see some of the same problems that you're seeing with AI and with RPA now combining into one. And that doesn't mean there's not opportunities there. I think it's just how quickly we go into it and how much we actually learn from what we're seeing and how we're seeing people use it.
And right now, the software companies are expending a lot of time and energy to try to engage their customers with these tools. They're not necessarily charging for the tools yet. They just want the customers to get used to it and use it. How do you think that's going to play out over the next year? Do you expect high error rates where customers will push back and say, you know what, this is not ready for prime time just yet. We wouldn't want to pay for this. We're excited that you brought this out, but we're not quite there yet.
I don't know, because it kind of depends on how much they want to play with it, right? How much do they want to contribute, or do they just want it to give the answer? That's going to be an interesting point. I mean, we haven't minded so much our privacy questions. So I think many people would have predicted some of the privacy questions that came up with some of our mobile phone use, for example, that we said, no, for this benefit, I'm willing to give up that privacy. So I I would wonder, will people say, well, no, I want to help the AI. I want it to be wrong sometimes so that I can figure that out and play with it. I'm curious if some of that will happen.
Interesting.
So as people try to figure out who's going to win in this next stage of the AI race, you're already seeing them place bets on like the next NVIDIA, Broadcom being a perfect example, right? With the market cap surpassing $1 trillion today. Is Broadcom likely to be NVIDIA light? Is there enough room for it to be just like a smaller sibling of NVIDIA and get there?
I mean, one of the things I like about Broadcom is that they have a different approach. So they're much more custom and working with people closely. So working with Meta closely, working with TikTok closely, and Google as well. So it's kind of a little bit more customized than mass market. And so that's going to be a question, is that little sister, if you will, going to grow up to be bigger? Because it's being fed by all of these people that need some more specialty than broad market. But is that going to be too expensive to deliver too? And I think that's going to be where the trade-off is.
And that's something that we'll see shake out in 2025, or at least we'll start to see it. Jana, thank you as always. Jana Eggers, the CEO of Nara Logics and our go-to person on all things AI. This is Bloomberg Markets to Close. We'll be right back. Growing demand for fertility treatments like IVF have turned this industry into a $35 billion business. But there's a dark side to this trend, and it's putting the lives of women who donate their eggs at risk. Bloomberg Investigations reports.
The Dalits are among the most marginalized groups within the Indian caste system, often deprived of quality education and jobs.
All of us women are sanitary workers. I'll get 450 rupees a day. 100 rupees go toward our food.
But these women carry something more valuable than anything among their family's modest possessions: their fertility. It's an open secret that she is the fertility agent. She's a cog in a sprawling network of agents and go-betweens across the country, profiting from the sale of human eggs. Every 15 seconds or so, human eggs are taken from a woman somewhere on the planet to satisfy the global demand for assisted reproduction. Advocates warn that India's poorest women are at the mercy of an industry that preys on the most vulnerable. For Sumati and the other women in her village, the people who make the laws feel worlds away.
This story is part of today's Big Take story and the focus of the latest issue of Bloomberg Businessweek magazine. Joining us now for more on this is Bloomberg News senior investigative reporter Susan Berfield. Susan, great to speak with you. Human eggs are a premium commodity. That is the title of this article. And as much as we talk about the world deglobalizing, the supply and demand of human eggs basically knows no national borders at all. It's not held back in any way. You talked with women around the world who donate their eggs knowingly and sometimes unknowingly. What surprised you the most in those conversations?
Yeah, thanks so much. So yeah, as you said, first, one of the things that really surprised us was exactly what you described, the global nature of this. And, in some ways it seems obvious because we've probably heard about medical tourism and specifically fertility tourism. So, we found that people and doctors also, and the agents that kind of connect everybody, they move around depending on where they can operate most efficiently, where they can, if regulations change in one place, they might move to another. If circumstances change in one place, they might move to another. And so what we found is that, as those networks kind of shift, that the populations, some vulnerable to exploitation, other seizing an opportunity to sell their eggs, those change too. And so that it's a very fluid marketplace and one that's growing.
And in one that is not regulated consistently across different regions. In terms of women who are selling their eggs, what was the highest price tag that you heard of?
Well, among the women that we spoke to, the highest price was about $35,000 for a single retrieval. So that's for the women, it's about, at least a 2-week process that involves daily injections of hormones, some discomfort as the ovaries swell to accommodate a growing number of eggs, and then a procedure that requires anesthesia to extract the eggs. We heard talk of prices much higher than that. And even going way back in the U.S. To the late 90s, there were advertisements for a very particular kind of egg donors, who were very smart, very well educated, very attractive. And back then, families were offering $50,000.
Yeah. I am curious, though, about some of the disparities geographically when we talk about the pay that some folks get. And that was one of the more interesting things in this story, how you can have women in developed countries who are giving their eggs away willfully, making pretty decent money for it. And then you have folks like you've profiled in India and in China and in South America that are making, the equivalent of, a few $100 US for doing the exact same thing, probably to have their eggs going off to a developed country where they can charge more for it, or the end user can charge more for it.
Yeah, so one of the interesting ideas I think for us was, how are human eggs valued, and who is determining how much they're worth? And if you want to think about this as a marketplace, which might be uncomfortable for people, but I think is fair, then, as in most marketplaces, the price is determined by the buyers and how much people are willing to pay. And that really depends on all sorts of things, people's circumstances, in addition to like how much people are willing to pay for a specific kind of egg, from specific people.
But the interesting thing about this, Susan, and we talk about this idea of regulation. The free market is a free market, but free markets also tend to have some modicum of regulation, some modicum of sort of what can be charged, or maybe at least the fairness in how those charges are applied. When you're dealing with something like this, where a lot of countries don't have rules, not to mention the whole cross-border nature of these types of transactions here, is there any hope that we could see better guardrails around this to protect both the donors and, for that matter, even the people who are receiving the eggs down the road?
Yeah, it's a really huge question. And it does, it depends. So every country, as you're suggesting, has regulations of some sort. There's always a question of how those regulations are enforced. And like anything, can the regulators keep up with the practice? Our focus, was in part on the compensation, as you've asked about. And, that is something that I think the U.S. tried in some ways to set caps on. It was unofficial guidance by a trade group, and that was challenged in the courts. And the cap had to be lifted. So the U.S. has already kind of gone through that. For other countries, there are also limits. And I think from our point of view, the more important question probably for the donors is what protections are there for their health and for their overall safety. And so, we talked to donors who had donated repeatedly. There's guidance in the U.S. that I think is followed around the world that donors should only go through this entire cycle 6 times. But we spoke to many donors who had gone through far more than that, and the long-term health risks to them are not known.
Yeah, and oftentimes they're young women too, so it'll take decades for us to realize what it is. Susan,
that's right.
Fantastic reporting there. Susan Berfield is a senior writer with Bloomberg Businessweek, senior investigative reporter. And of course, you can listen to the latest episode of the Bloomberg Big Take. It will focus on the human egg trade wherever you get your podcasts. I guess we need to recap what happened on the week in terms of market action.
Yep.
Well, right there on the day, nothing much, at least at the S&P 500 level. Unchanged on the day, down for the week, ending 3 straight weeks of gains.
Might not look like much in terms of the equity market, but this was a massive week in the Treasury space as the repositioning around the end of the year, and more importantly, around that Fed meeting. You look at 4.39 on your 10-year yield, and that jump that we saw on a weekly basis, the biggest jump on a weekly basis all year long. Similar moves on the 30-year yield, and that really sets us up for what happens to the short end of the curve when the Fed makes its decision on Wednesday.
Yeah, the 10-year now yields more than the 3-month. That's right. A key part of the yield curve, disinverting.
A disinversion. I guess maybe that might be good for economic prospects, not necessarily good for an equity market that's hoping for a drop in rates. A lot more coverage coming up here on The Close. Stick with us. This is Bloomberg. Welcome back. It's time now for our next up segment. This is where we highlight entrepreneurs, trendsetters, and other folks really moving the needle in the markets, in the world of technology, as well as in financing. And today we're taking a look at a company called StoreCash. The company is on a mission to disrupt the cashback industry. It offers customers the ability to maximize their savings through brands like DoorDash, Ulta Beauty, and The Gap. The CEO and founder of StoreCash joins us right now. Daricus Releford joining us from our Los Angeles bureau. And Daricus, we spoke to you, I think about a year ago, and this company was just kind of getting off the ground. You were gaining a lot of traction. I know you've had some funding rounds since we last talked to you, a funding seed round, I should say, that just closed last month. Can you just kind of give us an update here on where we stand?
Yes, it's great to be here again, Romaine. We just closed about $3.7 million in this seed round, and it's really to help for development with the app, to build a stronger user base, and also to kind of help build more value for the customer.
When we talk about cashback programs, Daricus, as you know, they're everywhere, from the big companies to startups like yourselves. What is different or unique about StoreCash?
Yeah, so StoreCash allows for you to not only save money at over 400 major retailers, but about 7 to 15% on average. And the great thing about us is we named it StoreCash because we're looked at as cash at the store. So if there's a discount in store or other coupons, you can use that on top of StoreCash savings.
And I remember we talked to you and you explained how you started the company in a way to figure out a way to send money to your nephew, Will, and then later on to help him save money as well. That is part of your origin story, but I'm curious, a year into this now, in terms of your customer base, do young people, teenagers, for instance, make up the lion's share of your customer base, or has it actually turned out to be a broader sampling?
So it's actually pushed more towards moms and people underbanked, and teens still use it, but we've noticed that mothers and the underbanked use it even more.
Interesting. So can you give us a glimpse into their behavior? Because as you build out this cashback model, which you say is different from the traditional one, you're looking to maximize value. So you're putting a lot of thought into it. How much time and effort do most consumers put into any cashback program that they join? I think about like getting inundated with emails, and sometimes I might respond, sometimes I won't.
Yeah, well, users, it's really simple to use the app. You use it through our app, so you can just tell us your total, and what we do is allow for you to get a QR code and barcode, and you just scan that in order to save. So people interact with the email, but most users use it with about 3 to 5 different stores, and then they start expanding from there.
How do you sort of get these corporate partners, Daricus, and what's sort of the pitch when you go in there? Because I'm sure they're getting pitches from, you know, the heavyweights out there, you know, big banks and other big fintech firms here. So when you're going in there and trying to sell them on a relatively small startup here, what ends up being the selling point to them?
Yeah, so we focus on the underrepresented communities. And one thing I've noticed when I was working at Google in Google shopping sector is a lot of these retailers don't focus on the average American. They focus on Americans making about 70,000 plus. So that allowed for me to see kind of a gap in the market and really tell them like, hey, I know you focus here, but we can expand that total addressable market by partnering up here with StoreCash.
When you talk about, I guess, you know, real people, real Americans, whatever sort of euphemism we want to use, I think we all know what we're talking about here. It gets to this idea, Daricus, are you able to kind of see into, I guess, how those people are really feeling sort of what their economic condition is. I mean, this was a big topic all year long because we, on this show, we're looking at economic data. We're speaking to, Wall Street audience, and it's good times, man. But if you're on the ground, there are still people talking about the price of eggs and the price of gas and things like that. So how much of a lens do you have into that corner of the economy?
So we don't have a huge lens as of the moment right now, but we're actually adding a tracking and budgeting feature into the platform. We'll be able to see the user's spending altogether, not only explain to them how much they should have saved that year prior, but also how much they should be saving moving forward, and also being able to clarify and just help with their budgeting and spending whenever they go out and use their card. So we'll be adding those features into the platform. But as of right now, what we're seeing users use the savings for is focusing more on, some users, we just did a user study, and some users are using it to pay their cell phone bill. Or to save up for Christmas at the end of the year, or to save up for their car. Most users are saving somewhere around $75 to over $100 a month. So the average user saving somewhere around $900 a year has really been beneficial for down payments and things such as that.
What's been the activation rate, people using the QR code and then signing up and creating an account during this holiday shopping season? I'm really curious to hear whether that incentive of saving more and getting cash back is really catalyzing people to do something as they spend money for their loved ones. I'm sorry. Could you repeat the question? Yeah, it's holiday shopping season and people are going out and spending money, and you have a QR code at your partners. I'm wondering what the conversion rate looks like.
Oh, so the conversion rate with our retailers and the users using the platform. So most retailers that are on the platform, whenever they go to any of these retailers, previously, of course, they were using their cart. We're seeing now that they're using our platform whenever they go in there. So conversion rate could be somewhere around, I believe, want to say in the 86th percentile of users whenever they come into the platform. 86% of those users stay on the platform and use StoreCash as a way to save at those retailers.
Got it. Daricus, really appreciate your joining us and giving us a look into how StoreCash looks like a year or so into its founding. Daricus Releford is the founder and CEO of StoreCash, a disruptor to the traditional cashback model. Let's stay with next up, because our next guest focuses on women of color. We know that women of color are constantly working towards seeing themselves reflected in society and the broader economy. Our next guest took that mission quite literally. She founded Be Rooted, a lifestyle brand that makes everything from stationery and planners for business to candles and puzzles for pleasure. The unique and stylish items feature drawings of women of color and motivational quotes for all your daily wants and needs. We're pleased to have Jasmin Foster, founder and CEO of Be Rooted, join us now. Jasmin, great to see you.
So good to see you.
So you spent years working in retail. You look at your biography, your LinkedIn page, you were a buyer for Target and for Amazon, among other consumer-facing companies. At what point in your corporate career did you see space for a lifestyle brand targeted at women of color?
Yeah, as a corporate retail buyer, I spent all of my time reviewing hundreds of brands. And I never really saw one that centered their work around women of color, Black art, and really empowering and uplifting us. And so in 2020, I said, well, let me stop waiting for someone else to create this. How about I create this myself?
Right. You just weren't seeing it among all the different brands that are coming in. So you started with stationery, and this is an obsession that began when you were a young girl, collecting journals and notebooks, I believe in the 90s, right?
Yes, absolutely.
But in the digital world of 2024, how do you build demand for, frankly, analog products like physical calendars or physical cards?
Scarlett.
Well, I think you'd be surprised, most of us actually grew up with phones at our fingertips, and we're oftentimes looking for ways to actually disconnect, take a moment for mental health, a pause and a break, and I think that our products are a great solution for that.
And I was just say too, Scarlett, there's been like a resurgence among young people in using, more traditional paper things. I've seen it. To that point, though, it gets to this idea of like who you're targeting. I mean, I don't mean in terms of racial demographics, but in terms of age and things like that. I mean, is there a certain sweet spot that you're going for in terms of demographics of the people you think are going to be more interested in your products, or are you just kind of trying to please everyone?
No, so I mean, there's really two ways into our brand. You have customers who are looking to increase their productivity and go after their goals. So someone's really between that 35 to 44 range that they're coming to us because our products help serve a need. But there's also that guest that is just obsessed with having products that represent them. And so we also serve that customer as well who's looking to find products that they get to carry around them in their everyday life that feel like a piece of culture in their hand.
Did your experience prior to founding Be Rooted, did your work experience help you in sort of approaching Target or some of the other corporate partnerships you have? Did it make it easier to go into those rooms and make your pitch?
What I'll tell you is that being a retail buyer myself, it helped me understand the lingo, right? So I never worked in stationery. I didn't necessarily understand the exact specifics of that category, but it did help me have that common ground conversation, understand what their needs were, make sure that my product was positioned in a way that would show up on shelf and actually sell off the shelf. And so I definitely think there was a benefit there of having that common ground to speak the same language.
You also got a chance during your corporate career to see firsthand what made brands successful, what made them work. And I know that there's probably a long answer to a pretty simple question. So let me ask you the opposite. What kills a brand? What makes a brand flop? And so therefore, what do you strenuously avoid as you build out Be Rooted?
Yeah, I think the main thing was that you are starting your brand and you're assuming that your customer is just going to know that you're there. You're going to give the retailer, make the retailer do all of the work to really push your brand for you. Really, as a brand owner, you need to be working every single day to make sure that you're getting your messaging out there, that your core demographic knows where to find you, and that you're actually pushing marketing dollars behind that spend. You'd think that was something that people would know, but you'd be surprised how many people get on shelf and say, okay, I'm done.
So how are you doing that with Be Rooted?
Yeah, I think in the beginning phases, because I was a super small brand, we got into retail 9 months into my brand launching. Wow. Which I would not necessarily recommend for people. Maybe take a little bit more time to build up your audience. But we did a lot of word of mouth. We did brought on PR very early to ensure that we were, getting the word out that way. Social marketing has been an amazing way. The internet can help change your life, right? So videos going viral and customers being able to find us in stores and leaning in on community groups like the Black Girls in Target group that really talk about and help socially evangelize brands amongst our community.
What's going to be the longer term commitment from partners like Target? They've, of course, have been very accommodating to having more diverse representation in their product lines and working with up and coming entrepreneurs. I'm sure you're very familiar with some of the pushback that we've seen in the political arena to initiatives. So we'll just use DEI as an umbrella term. And I am just curious as to whether you're worried about the commitment that some of your corporate partners might have to this and whether that could change in 2025.
I definitely am aware of all the things that are being discussed, but Target's been an amazing partner to my brand so far. And I feel like if we continue to be a brand that meets our goals, our customers come in and love us, and they continue to be obsessed with finding our brand at Target, we will continue to be a brand that retailers see as a good fit for them. But with all business challenges, there's 1,001 things that as entrepreneurs have on the back of our mind. And I'm sure if that comes to be a problem one day, I will figure it out. But until then, we're going to keep leaning into where we're working well.
Okay, that was my serious questions. Now this is the fun question. Because when I told my wife that you were coming on, she immediately, I didn't know, apparently our house is full of her stuff, which I didn't know. My wife was pulling out boxes and with the, with the logo. Who does your illustration? This is her question, really. Who does your illustrations?
Well, for your wife, I have an amazing team of designers that work for me that help make my dreams come true every single day. And so we concept out all of the artwork, and then we have a team of designers that help bring it to life.
All right. Well, she's a big fan.
I love that. Tell her we thank her.
Sure.
What's in line for new products in 2025 and 2026?
Yeah, so we're working on the kids collection. So from the beginning, people have been like, we love your stuff, but I want something that I can gift to my young kids. And we wanted to take the time to really focus on just getting that core customer right. But I think this is the right time for us to come out with a kids collection so that Be Rooted can be throughout the entire family.
All right. Well, this is a wonderful story and some wonderful products. Jasmin Foster is the founder and CEO of Be Rooted, one of our folks that we're featuring today in our Next Up segment. Again, the entrepreneurs and really kind of the future leaders of this country and of business and finance, folks to really keep an eye on. We're glad that you've kept an eye on us all week long. It is a busy week, and it's going to be even busier next week. A lot coming up here. So here's what markets will have their eyes on over the next 5 trading days. And we start on Monday with a big global focus, including those global PMI releases.
Yeah, not to mention Chinese economic data as well, especially after Beijing leadership made really clear that they're going to move forward with stimulus in a big way. And they were, much more clear than they had been in, say, late September, early October. And then we have a confidence vote.
Yeah.
Yet another one.
I know. When I saw that, I was like, didn't we just have
Yeah,
one? But
we did.
okay, so France goes through its issues, and now Germany and Olaf Scholz going through his. We'll keep an eye on that as well. Let's keep it moving here. On Tuesday, we do have a big economic report here in the U.S., and that is retail sales.
Yeah, retail sales will be critical. This is obviously not for the month of December, but it gives us a glimpse into how people are spending ahead of the holiday shopping season. Right now, people are looking for a gain of 0.5% for November.
Of course, a real highlight of the week is going to be on Wednesday, the conclusion of the two-day Fed meeting. Jay Powell, the expectation, a 25 basis point rate cut, but he's still got to have a press conference, Scarlet Fu, and answer a lot of questions.
Yeah, that's where everyone sees this hawkish cut coming through, right? Because they're going to pare back their expectations of rate cuts in 2025. Julia Coronado was just telling us instead of 4, she now sees 3 baked in. There's a lot of questions that Jay Powell will be answering, especially when it comes to how he's going to fold in expected policy changes from
well, he might not answer them. He'll be asked.
That's true. That's
he
true.
may not answer them. We do get earnings that day as well out of Micron, General Mills, and Lennar. And then we move to Thursday, an update on GDP numbers from the most recent quarter. This will be the third update, so really some tweaking.
Mm-hmm.
But we do get existing home sales and a few other data points that I think the market will be interested in.
Absolutely. And, earnings also does the same thing, right? Because FedEx will be reporting and Nike will be reporting. And these are...
And Darden, too. So that's a real nice cross-section of the economy.
Absolutely.
Yeah.
How people are spending, right?
Yeah, absolutely. How people are spending. So FedEx, Nike, Darden. And then on Friday, you get Carnival, so you get a more discretionary look at how people are spending. But also some interesting economic data on Friday as well.
Yeah, University of Michigan consumer confidence. And we've seen how Republicans feel a lot better about the economy and Democrats are feeling a lot worse. And that split will probably continue to widen.
The monthly PCE data also out here, personal income and spending as well. We'll have a full breakdown of all of those events next week right here on The Close. We appreciate you watching. For all your politics coverage, we want you to stick around. Joe Matthew and Kaylee Lyons are coming up next on Balance of Power right here on Bloomberg.